Hi, you're watching Investor Insights. It's Friday morning, 7 a.m. It's the 23rd of August, and it's been quite a big swing overnight and yesterday. We had the S&P futures yesterday morning trading at 1630 odd, and this morning they closed up almost at 1660 odd. The Aussie dollar, when I was in bed yesterday morning, was actually almost went through 89 on the downside, 89.3, and some fudged up Chinese PMI data came out, and it pushed it back to 90, and overnight it rallied almost as high as 90 and a half. You've got the pound, which is exactly where it was yesterday morning. You've got the euro exactly where it was yesterday morning, so not too many moves there. The yen is a lot lower, and that's predominantly more a function of the markets being up rather than anything fundamental, because this yen's going to go a lot lower anyway. Everything I'm talking about is against the US dollar. Personally, I'm not a big fan of the US dollar, but when push comes to shove, when you trade currencies, it's one against another, and at this point in time it's an ugly contest. So trying to work out who's uglier or less uglier than the other. I saw a great number of articles last night and this morning, but there's two that I'd like to highlight. The links are in the description box. The first one being the next great rotation will be into European stocks, and amongst the commentary within that article, some realist actually had to mention that although there is expansion in Europe, it really isn't anything to boast about or to celebrate, because the growth rates are too low to address the debt crisis over there. And this is actually the first time that I've seen the debt crisis mentioned in an article on Europe or America. Most people just want to bury their head in the sand and just pretend it's not there. But you and I should know that it's there, and debt never disappears. If you aren't sure of that concept, just go borrow a whole bunch of money from a loan shark and see if that guy's going to go away over time. But more to the article, the whole world overnight became a happier place. There's a lot of happy talk, there's a lot of celebrations going on because the Chinese PMI reached its highest number in 4 months. It's expanding, everything's all rosy. And Europe, the manufacturing data from Germany is very helpful. But don't forget, Germany is an exporting nation. It actually manufactures stuff. Germany is a good example of an economy that actually relies on technological innovation and efficiencies to mass produce consumer goods, whether it be cars or electronics, whatever it is. They do a good job of it. But whatever happens, the one thing that's always going to be lurking in the background is the debt problem. Doesn't matter if it's France, doesn't matter if it's Germany, UK, the issue will always be there. And the only way to pay debt or to make the debt go away is to have significant growth, so that there's a lot of revenues, increases in top line revenues, so you can basically pay it off. But what's happening now is clearly not that, either in the States or in Europe, because all that's been happening is the growth is basically inflation. And I keep on getting back to that, and a lot of people may or may not want to believe it, but it's true. If you look at the top line growth and you take away even the government inflation numbers, there's hardly anything happening. And if you take a real inflation number of closer to 5 to maybe even 10%, then everything's contracting. The real economies are contracting all over the joint. I'm going to make a video about what constitutes the excesses within economies very soon when I get a chance. But for now, I just want to highlight that debt begets more debt, and that spiral never finishes. And the central banks, especially the Fed, are trying to, or is trying to, make it disappear through hyperinflation. And I've made a lot of videos about this previously, so you can look it up. But inflation destroys your debt. So if you can't make an economy grow so that you can pay off the debt, or you structurally change your economy so that it becomes one of productive, high productive capacity rather than debt finance consumption, you're never going to get rid of the problem. And I think it's easier to make the debt disappear through inflation rather than make people actually work harder for a living. The other article that I read was about there's a huge global economic uptick as of yesterday. So the day before, things was tapering issues, the Dow's down 100 and something, and all the markets were down, and then overnight things change. If the economies or the stock markets were human beings, you would have them consult a psychiatrist, because that's huge bipolar disorder. You can't really be so enthusiastic one day and negative the next, or vice versa, by just having one or two pieces of economic data. Stock markets, or markets for that matter, are supposed to be forward-looking indicators. So that traders are already taking growth or less growth into account and are buying or selling the stock market in response to looking at companies' balance sheets and the environment and economic data, unemployment, inflation, and so forth, and making a judgment as to see where things are heading. But even now, when things are clearly distorted and the central banks are just printing money to infinity, especially the Fed, and that's just driving money into all these bubbles, stock market, bond market bubbles, you can't really put things down to fundamentals. So it's very hard to look at a balance sheet and say, well, where this company is heading next. It's very hard to put your finger on how a particular sector is going to perform, because the flood of cheap monies into the system is really putting things out of whack. I mean, I personally don't trade stocks anymore because it's just too hard. I'd rather just buy or short the indices. And I can tell you, I can count the number of times that I've gone long the indices probably on one hand in the past 5 years. Because regardless of if you're a technical a trader or a value investor and you only deal in fundamentals, most important thing is that common sense has to prevail. And if you're just a lemming and you don't want to use any common sense but rather jump on the bandwagon, see how the herd mentality, how far the herd mentality is going to take you, well, when this thing implodes, you're going to go down with it. But I like to always take a step back and try and evaluate the situation in terms of PE, in terms of looking at economic data releases. There's a caveat to what I just said, in that all the data releases are probably fudged. In fact, most of them are fudged. You shouldn't trust any data that comes out of China. I just read on the weekend that a couple of commentators believe that China's economy is overstated by about $1 trillion. Now imagine fudging your own GDP numbers so that they appear to be 9 trillion, so that's about 12% higher than what they really are. You have to be pretty brazen. But if the Chinese have been fudging their numbers for the past 5 or 6 years, I mean really blatantly fudging their numbers, who's to say that anything's different? You should always be careful when looking at Chinese numbers, or even investing in the Chinese stock market, because any country that is socialist in nature can just change its policies overnight, change things like its monetary, not just policies, but peg their currencies like the Chinese are to stir up demand. They're just not playing on an even court with everybody else. There's so much corruption going on in there, you shouldn't be looking at it. You'd rather invest in stocks that are fully transparent in their earnings, in their statements, in their guidance, rather than hoping for the best, which is what you're doing when you're investing in a lot of the Asian markets in the first place. Another thing I'd like to mention is in yesterday's update I said that the FOMC minutes were neither hawkish nor dovish. What I actually should have said was the statements were not any more hawkish or dovish than they have been for the past 4 or 5 months. By which I mean all the statements, all the minutes are basically the same. And all they do is change the date on each of those pieces of paper and possibly 1 or 2 words within each of the pieces of paper. And every time the rhetoric is the same. If the economy picks up, we'll consider tapering the asset purchases. If the economy stays where it is, then nothing's going to change. If the economy worsens, we might look to buy more assets. And if this sounds like a broken record, well, it's because it is. And to be so excited about a market when these minutes or the statements are released, I don't even know why people bother. If you know that everything's going to be the same, why don't you just sit on the sidelines as opposed to being caught up in these crazy swings? One more thing I'd like to mention is you've got to look at a lot of the articles, and in each of the articles everybody is always bullish. It doesn't matter how the economies are heading, it doesn't matter what the data releases are. There's a lot more bulls than bears out there at the moment, or there has been for the past 5 or 6 years. And predominantly the reason why is because they're all hedge fund managers or portfolio managers. Whatever that they are, they want your money. So therefore they have to seem bullish, they have to appear bullish, and to them it doesn't matter if they win or lose. They take a management fee out of your money, and that's all that they care about. And right now this rising tide's lifting all ships, and by lifting all these ships, all these stocks, a lot of stocks are just ridiculous. Look at Netflix, 14.5 billion market cap for earnings of what, 15-18 million bucks. That's insane. The PEs are so stratospheric that putting money in it is just, I don't really have a superlative for it. I would just say take your money and flush it down the toilet, because when this thing breaks it's going to be immeasurable. The losses will be a lot greater this time around in this stock market crash than the previous one, simply because there's a whole lot more people who are jumping in now, and there's a lot of government monies which have found their ways into the markets. So it's not just individuals' money that's going to be lost, it's also going to be government monies. But that's a story for another day. The main point that I'd like to highlight today is the fact that, as with every other day that I mention it, the stock markets are beyond stretched. The valuations are just fanciful. So if you enjoy flushing money down the toilet, if you enjoy playing with the herd, and if you enjoy pulling all your hair out when this thing implodes, by all means go ahead and do it. You're going to get crushed. And I don't really see any point in putting any money at work in any markets right now until you have a more stable outlook on the debt problem. The debt crisis. If you can't get rid of it, it's always going to be the bugbear, and you don't want to trade with one of those in the room. It's just too hard. Money's hard enough to make and save. Why burn it up this way? I think I'm going to go to bed now. I might make an update when Europe opens in a few hours, but we'll just see how this one goes. Until then, have a good one.